Okay, uh, so today we'll have our lecture on plant assets. Um, Plant assets is a broad term that we'll use to refer to um, assets that have a tangible substance or physical substance, something you can go see and touch, that are used in the operations of a business, right? Not for sale. They're not inventory. They are used in the operations of a business, um, generally in furtherance of the business's interest, and they last more than 1 year. Right. So, by requiring that they last more than 1 year, we exclude things like supplies and pens and pencils, things that companies don't sell, but that are used in the business. So we're talking long-lived tangible assets. Think land, think buildings, think vehicles, cars, planes, trains, automobiles. All right. The terminology that we'll use for this chapter includes uh, PPE, which is plant, property, equipment, plant equipment, fixed assets, capital assets. Um, all of those terms are interchangeable. So if you hear me refer to using any of those terms, then just understand that we're talking about plant assets. All right. So back in chapter 1, we discussed the historical cost principle, and we're going to see that in application here because historical cost tells us that we're going to show assets at what the company paid for them, plus any expenditures required to get the asset ready for its intended use. We don't adjust for increases in market value. That's just something that generally, never with plant, property, and equipment, we don't do that. Land is the cost of land is what you paid for it plus any accrued taxes, accrued property taxes, closing costs, and commission. All right, and that's the amount that you would see in the land asset account. All right. One other thing to note is that when we start into calculating depreciation, land does not, in fact, depreciate. All right. Land improvements. Land improvements, however, do depreciate. They are depreciable, and these are things that you put. They're attached to the land, but will need periodic refreshing. So landscaping, fencing, sprinkler systems, those are all examples of land improvement. They have a limited useful life, and they do depreciate over the life of the estimated useful life. All right. Buildings. So buildings are attached to land, and buildings is pretty self-explanatory. They are the structures that occupy the land. The building asset should reflect the purchase price if it was purchased in a basket transaction. That is, i.e., with land or other land improvements. Then a portion of closing costs would be attributable to the building, any commission, and then all costs necessary to get the building ready for its intended use. All right. So if I'm opening a Chick-fil-A franchise and I buy a building, then all costs necessary to make it look like a Chick-fil-A would be building costs. All right. If I have a building built, like York College did with the Wilman Business Center, all costs during the planning phase and through the completion of the building through the completion of the building are building costs and would be reflected in the building account and would be depreciated over its estimated useful life. Typically, buildings are depreciated over 35 or 40 years. Equipment. For our purposes, equipment is kind of a catch-all category, so if it doesn't fit in land improvements, or building, it falls in equipment, and it's a broad category, and it will include everything from an airplane, forklift, front-end loaders, a piece of heavy machinery, we'll call it a press, stamping press to stamp out car body panels, something that you might see in a General Motors plant. That would be equipment. It's also going to include vehicles, trucks, things of that nature. So it's a broad category, and our text uses it as a catch-all category. The amount that we would see debited in the equipment account is the purchase price for the equipment plus sales tax plus any freight and insurance during shipping, and all setup test work for to get the asset or the equipment ready for its intended use. All right. Relevant problems to work here in the text: E9-1 and E9-2. Okay, in the second learning objective in this chapter, we will talk about depreciation, and this probably classifies as the most important learning objective. Well, it is the most important learning objective in this chapter. So depreciation is the heavy lifting for this chapter. All right. So depreciation is a systematic approach to spreading the cost of long-lived assets, i.e., assets benefiting more than one accounting period, over their estimated useful life. And that's depreciation, right? It's easier to remember or to think about what depreciation is not. All right, so depreciation is not a process of asset valuation, i.e., at no point in time should depreciated asset net cost, so the historical cost less accumulated depreciation, it might not necessarily equal current valuation, and that doesn't necessarily mean that the asset is being depreciated incorrectly. All right. There is no, quality, reliable metric that would reflect asset valuation, nor do we try to do that. Depreciation doesn't do that. But what it does do is it expenses or charges to expense the cost of assets over its useful life. All right. Also remember, it is a violation of GAAP to depreciate land. Land does not depreciate. When the value of land declines significantly, we may record what we're calling impairment, but that's outside the scope of this chapter in this course. Alright, so when we're given depreciation problems, you'll be given several pieces of information. Cost, what the company paid for something, and generally the cost will be inclusive of all costs ready to get an asset for its intended purpose. In some problems, you may have to add freight and other things to get the cost to depreciate. But you'll be given either cost or the means to determine depreciable cost. Useful life, which again is an estimate. Management guesses when they buy an asset how long it will last, based on the asset being purchased, based on the intended use, based on the useful lives of similar assets. And, that's an estimate. And then salvage value. That is when the asset is done, i.e. at the end of its useful life, what does the company think they'll be able to sell that asset for? All right? Sometimes referred to as scrap value or residual value. All of those mean the same thing. And in the visual here, we see the asset at the end of its useful life is kind of beat up, maybe not useful to the company anymore. And hopefully that visual kind of helps you understand salvage value. All right. The one other thing. So we'll have some accounts to be aware of. Actually, let me go back one. So we'll have an asset account. For the truck, it would be equipment. All right. And that's going to reflect historical costs until that asset is either remodeled, renovated, which we'll talk about later in the next learning objective, or sold. Right. As the asset depreciates, we'll increase what we a contra asset account called accumulated depreciation. Both the equipment asset account and the accumulated depreciation are balance sheet accounts. Accumulated depreciation is a contra asset account, and they're reported net of each other on the balance sheet. All right. So we're going to be responsible for three types of depreciation. There are others that exist in the real world, but based on the chart here, you can see that there's one predominant approach to a depreciation. That's the straight line. And once we get into it, you'll see why. It's the most straightforward. It's the easiest, and it gives you a predictable expense each period. All right. We'll also talk about units of activity, which lends itself well to like manufacturing and things of that nature, where we use some actual measure of output, i.e. miles driven, machine hours run, or what have you, to form the basis of depreciation. That's also fairly straightforward. And then we'll talk about the declining balance, which is an accelerated form of depreciation. The computation is a little more difficult, but again, nothing this group cannot handle. All right, so we're going to use this example. Bob's Florist purchased a small delivery truck on January 1st, 2015. And we're going to use the cost of $13,000 salvage value. So the company expects that at the end of its useful life, it's going to be worth $1,000. They'll be able to sell the used truck for $1,000. They expect it to last 5 years, and they expect it to last 100,000 miles. All right. So to be sure, each of these, this 1,000 expected salvage value, is an estimate. There's no possible way you can know exactly what something's going to be worth 5 years into the future. This 5 years is also an estimate. There's no possible way you can know that a vehicle will be worth exactly, that it will last exactly 5 years. That's an estimate. And this 100,000 miles, again, an estimate. It could last less, it could last more, depending upon what you do with it and other factors. All right? Straight line. Most straightforward, and it's easy because it gives you the exact same amount of depreciation expense, which is our income statement expense, each year. All right, so you have to do one calculation for straight line depreciation, and then that you've got your expense for each year that the asset is in use. All right. So we have that formula, which is cost minus salvage value, gives you depreciable cost. Applying it to the instant example, the $13,000 for the truck less what management expects it to be worth at the end of its useful life, gives us our depreciable cost. All right. And then all we need to do is take depreciable cost and divide it by estimated useful life, in this case 5 years, and we get our annual depreciation. Alright, so this is what we call a depreciation schedule. And in this schedule, we have columns for depreciable cost, rate, which effectively is just the 100% divided by the useful life. We'll see that. And annual depreciation expense, alright, which is depreciable cost times the rate. Accumulated depreciation is the sum of all depreciation on that asset as long as the asset's been owned by the company. And book value at any given time is depreciable cost less accumulated depreciation. So let's take a look at this. Alright, so the depreciable basis on this truck is $12,000 less the $13,000 less the $1,000 residual, our salvage value. The rate is 20%. The way we get that would just be, it's a 5-year asset, so each year it's going to decline 1/5 of its value, or 20%. Alright, so 20% of 12,000 is 2,400. Since 2015 is the first year the asset was placed in service, the depreciation is equal to the expense for that year, and that gives us a book value of $10,600, which we calculate by taking the purchase price of $13,000 less the accumulated depreciation, and that gives us $10,600. Alright, there's our journal entry. So a debit to depreciation expense and a credit to accumulated depreciation. Alright, and that journal entry would be repeated in each year of the each of the 5 years that this asset is in its useful life. So in year 2, we see the same calculation. The only number that changes is accumulated depreciation, because now we've had $2,400 of depreciation expense on this asset in 2015, and another $2,400 in 2016, giving us $4,800 and a book value of $8,200. All right, and this process would continue for each of the 5 years. Each year, accumulated depreciation increasing, and the book value would decrease. At the end of 2019, which will be the 5th year, the asset depreciable cost is going to be equal to its accumulated depreciation. So the book value at that time would be $1,000, equal to the salvage value. All right, so that's a little hint there that the book value, once an asset is fully depreciated, is going to be equal to the salvage value. All right. One other thing to keep in mind. Okay, I'm sorry. I just had a. Okay, we're going on. I'm sorry. One other thing to keep in mind. Here we go. One other thing to keep in mind is that if the estimates prove to differ, and at the end of the asset's useful life, at the end of 5 years, the truck is still viable. There's nothing that forces the company to buy a new truck or to sell this truck. You know, you just wouldn't depreciate any further. So if the asset continues to be used into 2020, 2021, you just use it and maintain it. You just wouldn't depreciate it any further, right? So the estimate proved wrong, and you just don't have depreciation. The asset would be what you call fully depreciated, and it would be carried at $1,000 book value until it is in fact disposed of. All right. What we're seeing here is a modification of the same depreciation schedule, but we're just assuming that it was purchased on April 1st instead of January 1st, which honestly is more realistic. Not a lot of business gets done on January 1. All right. So when the truck is purchased on 4/1, what we see is that we take partial year depreciation, so April through the end of December, 9 months, and so the first year's depreciation would be $1,800. Years 2016 through 2019 are the same. There's 12 months of depreciation in each of those years. In the final year, there's only 3 months left to depreciate the asset, so you take 3/12 of that amount, and the depreciation expense in 2020 would be 16, and that's partial year depreciation. All right. Okay. Units of activity. So here we use a unit of activity. In this case, it's miles driven. So the first step in the computation of units of activity, you start with depreciable cost. So again, we have taken the $13,000 truck cost less the salvage value to get a depreciable basis of $12,000. You may recall the truck was estimated to last for 100,000 miles. So we take depreciable cost divided by the measure of activity and get 12 cents of depreciation per mile. All right. And we could also have other measures. Machine hours might be one. The unit in activity really doesn't matter. It doesn't change your approach. All right. We'll have a few examples that illustrate that. All right. 12 cents, and then you always need to be given the actual activity. So in the first year, we have 15,000 miles, which gives a depreciation of $1,800. All right, so let's put together a similar depreciation schedule under the units of activity method. All right, this miles driven column, that information would have to be given, right? You wouldn't need to come up with that. We've already calculated the 12 cents per mile, giving us $1,800 in depreciation. First year, so also $1,800 in accumulated depreciation, and book value of $11,200. And of course, the book value would be the $13,000 purchase price less accumulated depreciation. In year 2, 30,000 miles driven. Cost per unit still 12 cents per mile, giving us $3,600. And accumulated depreciation of $5,400, which we would subtract from the $13,000 to get a book value of $7,600. All right, and then repeat the process, keeping in mind that the miles driven would have to be given information for you each period. All right, in year 2019. 10,000 miles, which adds exactly up to 100,000. But if more than 10,000 miles were driven in the final year, you still would not depreciate that asset beyond. Beyond the $12,000. So you could drive. I mean, again, the company can still use the truck. They can still drive the truck. The accounting standards wouldn't preclude that, but it wouldn't be depreciated below the residual or the salvage value of $1,000. All right. So as you can see, the depreciation expense here is not constant because it's based on a measure of activity. So this expense goes directly to the income statement. So there's going to be more volatility because of that. And that's one of the reasons that the straight line method is the favorite method, because it gives you a predictable depreciation expense each period. All right. Continuing on with the double declining balance, which is the most complicated method. It's what we call an accelerated depreciation method, which it recognizes more depreciation earlier in the life of the asset. Some of the value in doing this is that it's thought to, it actually does closer parallel the actual decline in value of some assets, like vehicles. If you have a car, it declines most right after you buy it, and then continues to decline, but at a lesser rate as it gets older. All right. So the declining balance method comes in several forms. The one we'll be responsible for is the double declining balance method, which is based on 200% of the straight value rate. All right, so you may recall the straight line rate was 20% because it was a 5-year asset. So our formula here, and this time another difference to keep in mind, we depreciate based on cost. We don't subtract out the salvage value when we're using a declining balance method of depreciation. So we take the purchase price and then double the straight line rate, which was 20% for 5 years. So we double that and take 40. And first year depreciation expense is $5,200. Okay. So let's set up a depreciation table for the declining balance method. All right. So again, we're using book value times a 40% rate gives us, in the first year, $5,200. It's the first year, so accumulated depreciation is $5,200. Subtract the accumulated depreciation from the beginning book value, and we get an ending book value of $7,800. All right. Continuing on, and we see the ending book value rolls to the beginning book value. So the beginning book value in 2016 is $7,800, and we take 40% of that number. All right, and we see what that works out to for depreciation expense for the year. We add that to accumulated depreciation, and we get a lower book value. And from this point, it's kind of wash, rinse, and repeat. All right, so ending book value becomes beginning book value for 2017. Take 40% of that, add it to accumulated depreciation, get book value of $2,808, 40% of that number. Depreciation expense for the year, $1,123. Add to accumulated depreciation, and we get a book value of $1,685. All right. So the thing to be aware of in the final year, or towards the end of an asset's useful life when using the declining balance method, is that the last year you don't depreciate below residual. So we ignore the residual value on the front end. We don't subtract it out. But on the back end, we still do not depreciate below that amount. So you see we have 685 here, which is not equal to 40% of 1,685. That's just the maximum amount that you can depreciate without depreciating below $1,000, which was the residual for this vehicle, for this piece of equipment. All right. So that's a quick fly through of the declining balance method of depreciation. We'll work this out, and we'll look at a few examples of this. All right. Here we see the declining balance method applied to partial year. So really, it's the same principle as straight line applied to a partial year. In this case, the asset was acquired on April 1st, and so during the first year, you take 9/12 of that amount, 9/12 of the computation, and in the second year, our years 2016 to 2019, you follow the same approach you followed on the previous slide. So you take the ending book value for the previous year, 40% of that amount is depreciation expense, and then kind of wash, rinse, and repeat until you get to the last year. All right, so you still cannot depreciate below $1,000, which was the residual. So you can never depreciate below the residual in any form, but also particularly the declining balance method. All right. One other thing to note is that we didn't do partial year for the units of activity method. You don't need to do partial year computations for that because it takes care of itself with the activity. So if you say this truck, if you purchased it in June and drove it for 7 months, well, presumably there's going to be less mileage than there would be if it was purchased in January. So you don't have to do partial year calculations under the units of activity method because the activity represents, it takes care of itself. Okay. Here we have a comparison of the three methods we discussed for this truck, the depreciation. Straight line method, we see same expense every year for each year the asset is in service. Units of activity varies, and it would vary based on activity. All right. The declining balance method, well, as you can imagine, it declines as the asset gets older. Well, in each of the three approaches, we've depreciated the same amount, but we've done it in a different manner. All right. Management tends to favor straight line because it is predictable. You know what expenses are going to be, so there's less volatility as it relates to income. Sometimes you might see the use of a declining balance method because it more closely reflects the actual decline in value of an asset over time. All right? All right. So you may recall when we started this learning objective, I said estimated useful life, that's an estimate. Residual value is an estimate. So with those two things being an estimate, depreciation at all times is effectively an estimate. Having said that, at times it becomes apparent that your estimate needs to be revised. All right? And you may recall from other instances or from other chapters, when you change an estimate, you don't go back in time and update previous periods. You do it prospectively, and depreciation is no expense. So if for example, with the truck, if you start to believe, or when you believe that the asset's useful life is not 5 years, but 7, then If you realize that in year 3, then you basically depreciate it starting in year 3 based on the remaining 4 years. All right, we'll do an example of that. That's in the abstract. We'll put some actual concrete numbers to that so that you can make some sense of that. All right. It is not a mistake when estimates change because there's just no one has a crystal ball. Okay.